this week we've seen a few key changes in the fundamentals. If we start off with the weather forecast, we've seen it revised warmer over the short term. That's looking to dampen demand for both gas and power over the short term. In terms of wind speeds, we've seen Storm Angus hit the UK shores, and that's seen wind speeds increase quite a lot, and that's doing two things. Firstly, it's in wind generation increase, so that's in power margins widen, but in terms of gas, it's also seen a reduced demand for CCGT demand, which is gas-fired generation, so we're actually seeing a bit more comfort in the gas system on top of that. In terms of nuclears, in the UK we've seen two planned nuclear maintenances in the coming weeks, which could act to tighten supply margins over the short term. In terms of the French nuclear situation, there's still around 15 gigawatts of nuclear capacity offline, and that's still acting to really tighten the system over in France, which in turn is having a knock-on effect on our interconnector flows between ourselves and France. Finally, looking at oil prices, we've seen them start to tick up over the last few weeks, as we've seen speculation emerge around the possibility for an OPEC production cut. Historically, Iran have said they're not going to come to the negotiating table, and that's always kind of put a fly in the ointment of any possible deal. However, they have now been offered the exemption from supply cuts if they agree to cap production, and that's now being perceived as by the market as potentially bringing Iran to the table and making a deal more likely over the short term. So as I mentioned, we've seen temperatures increase at the start of this week, as well as wind speeds, and that's seen day-ahead gas and power prices gap down at the start of this week. In terms of contracts also close to delivery, so the front few months, we're expecting to take direction from the day-ahead market and could see them trade lower at the start of this week. If we look a bit further out to seasons, it's a little less certain there. As I've mentioned, we've seen oil prices start to increase, and we've also seen a bit of weakness in the pound, and that could act to mitigate losses to seasonal contracts further out. So customers looking to place fixed price contracts should treat this recent downturn in prices as an opportunity to get into the marketplace and get those contracts fixed. In terms of duration, we've spoken about this quite a lot over the recent weeks. It comes a lot down to your attitude to risk. As we've seen, prices have come off a little bit, and if we look at seasonal prices further from delivery, we're actually seeing, specifically in power, a bit cheaper in years 2, in years 3, in years 4. So if you're looking at the current market and see good value versus previous years, then I'd recommend fixing over a longer period of time. In terms of flexible contracts, again, this recent downturn in prices we're treating it more as a buying opportunity. So if you're looking at your hedge levels and you've still got quite a lot of exposure and you're not happy with that moving into the riskier time of the year, so Q1, end of Q4, treat this as an opportunity to increase that hedge and mitigate some of that risk.